Earlier this year, President Trump took office with a promise that Americans were going to see an improved economy and a more affordable life that they could live here in America. Today, I'm going to share 5 key pieces and tax changes that he's proposed in a new bill that is set to come out. Now, these are just proposals. They are not in effect yet, and there are things that could be changed, added, deleted in the time until it comes out. But it's important to know what's coming up the pipeline. I do want to share 5 of those that are going to impact essentially every American, right? There's a lot of language in this draft. A lot of it's boring, but a lot of it's important because it does talk about taxes. So today, that's what I want to hit on. I want to hit on 5 of these and then a bonus at the end, so stick around for that. If you have any questions, as always, feel free to reach out to me at the end. So let's get started with number 1, and that is the extension of the Tax Cuts and Jobs Act of 2017. Now, the TCJA, that is something that has been looked at for a long time now. Of course, 2017 feels like a long time ago. And what this bill did then was reduce a lot of tax brackets. It added credits, it added deductions, right? It introduced a lot of tax benefits. And something a lot of folks were concerned about is at the end of this year in 2025, that bill is currently set to expire. And unless Congress does something, and unless this bill goes into effect, it will expire. So if we are able to extend that bill, what we're going to see is the continuance, the extension of our current tax brackets we're in. If it continues on and nothing changes, those tax brackets are all going to go up. What we're also going to see is an extension of the current standard deduction, which is higher than it previously was in 2017. A standard deduction is just simply the amount that every American can deduct off of their income every single year. So right now it's $30,000 if you're married, it's $15,000 if you're an individual. And what would happen if this expired is both of those would be significantly lower. One interesting thing I did see in the draft was that there's a possibility that an extra $4,000 might be possible for those making $150,000 or less as a family or under $75,000 as an individual. So we're talking about an added deduction on top of the standard deduction that the government already allows. So seeing whether the TCJA is extended is going to be very important. And for most Americans, it's going to be beneficial if it is, of course, continued. Second piece is one of the most talked about on the campaign trail, and that's because it's very new, and that is no tax on tips or overtime for Americans. So this one's pretty self-explanatory. If you make money from working as a waitress or a waiter, or if you work overtime as a service worker, all of that income is going to be fully excluded from your gross income for the year. So this is a possibility to save thousands, potentially, for a lot of you on your jobs in terms of taxes. This is, of course, interesting because this has never been applied before, but as I mentioned at the start of the video, we have to wait until it's finalized because this would take a lot of revenue away from the government. And I know, boo-hoo, the government, less revenue, but it is a new bill, so that's something to keep an eye on. Third piece here is probably going to impact a totally different person than number 2 that I just mentioned, and that is the estate tax exemption being extended or even increased at some point. So right now, the way that passing on wealth to your heirs works is every single individual has up to $13.99 million that they're allowed to pass on via their estate to their children or to whoever they choose to pass it on to and not have to pay taxes on it. Anything above that, the government starts kicking in taxes on. Now you can double this amount for a spouse. So we're talking about nearly $28 million that can be passed on by a couple to their children without having taxation. Now, personally, if you ask me, it is quite crazy that there's any exemption at all, but leave it to the government to have their hand in every bowl, nook, and cranny that they possibly can when it comes to taking income from its citizens. Now, I know that this literally impacts 0.01% of folks out there in America, but this is the important piece here, is that if this is not changed, right, if this is not extended, we're going to see this go down to somewhere around 5 million. And if you think about your retirement account right now, maybe if it's not even at 5 million or close to it, you have to think of what 10, 20, and 30 years of compounding is going to do to your retirement accounts. Keep in mind that $1 today is not worth the same $1 in the future, and the same is going to be true for your retirement account. So if you do have IRAs, 401ks that do have the possibility of being over $5 million, in addition to your wife's over $10 million, now it gets a little more interesting. So the extension of the lifetime estate tax exemption is going to be very important. There's even been talk, not specifically in the bill, but there's been talk of just making this permanent or, of course, increasing that over time with inflation, which is going to be another important thing to see. I'm sure they're going to say this is simply to help President Trump and his rich friends, which to tell you the truth, I will leave that up to you in your own opinion. But I know for certain that less taxation has generally been better for all Americans. 4 is probably going to be near and dear to those of you who own a home, and that is the SALT cap. The reason I say if you own a home, this is going to be particularly interesting is this is where property taxes come into play. So here in the great state of Texas, we do not have an income tax, but we have significant amounts of property taxes, right? As a homeowner, I know that one of my biggest pieces of my tax bill is going to be that property tax piece. And right now, you can only deduct up to $10,000 of property taxes, or if you live in a state with state income tax, such as California, you know that you're going to also be able to include any city tax, such as Los Angeles, any state tax, such as California, and any other tax that you have located around you. Now, as I mentioned, only 10,000 of that is allowed. So what folks were hoping for is that this was going to be extended up to $25,000. And I'm not seeing anything in this particular document that speaks on that. That doesn't mean that it's not going to be increased or at least extended, but we're going to have to wait and see. Now, I know that's less than positive, but let me share maybe a potential deduction that we're looking at that might be helpful for some of you, and that is simply being able to take a deduction on $10,000 of interest from a car loan. Now, I know a lot of you are probably currently paying off your car loan, and depending on when you got it, you're gonna have a different interest rate, but it never feels great to have to pay interest on something that's a depreciating asset, right? We all know the story. You drive it off the lot, it automatically decreases in 1,000% value, or whatever they say. But this is a potential bill that would allow for taking a tax deduction on part of that interest. Now, the special catch here is, of course, you have to make under $200,000 if you're married, and you have to make under $100,000 if you're single. And the ultimate bonus here is the car has to be assembled in America. So I don't know what assembled means. Maybe it just means put together. Maybe it means the parts are from America, to be seen. But this is a pro-American part of this bill. But no, you do maybe have potential to write off some of that interest on your car loan in the future. Now let's talk about number 5, and I'll get you out of here. So let's talk about HSAs and 529 plans and some possible changes that might be going on here. An HSA is a health savings account. This is simply an investment account that you can have for medical expenses if they're qualified, right? So you put money in before it's even counted as income. It can grow tax deferred, and then as long as it's used for a qualified medical expense, it's also tax free. What we're talking about with this drafted or proposed bill here is that your spouse can also make catch-up contributions, and that they're possibly even looking at extra contributions being made for older folks, and at the same time, people that are ill. One last thing that they're looking at adding here is allowing you to pay your Medicare or your long-term care premiums directly from the HSA. Now, the 529 plan, not too much has changed here. There was recently a big change with a 529 account, and stay tuned for my next video where I'm actually going to talk more about a 529 plan. But essentially with a 529 plan, we're looking at allowing homeschool expenses or allowing homeschool supplies as a qualified expense. And at the same time, maybe even rolling a 529 over into an ABLE plan. If you're not familiar with an ABLE plan, it's simply a 529 or tax advantage plan for a disabled person under the age of 26 years old. And if they have a lifestyle expense such as living, eating, just about anything, they can have a tax advantage way to grow and use that money through that ABLE plan. So that's some potential here. Now, the bonus that I mentioned here is the MAGA plan. So obviously it's a play on words, it's a play on President Trump's slogan. But really what we're talking about here is another potential tax advantage account, which gets nerds like me really excited. They're saying that it's going to be probably similar to an HSA or to a Roth IRA. And all that really says to me is that we're looking at some version of tax-free growth, either in retirement, for school, some expense that someone might want to save up for, maybe a first-time home. That would be really cool. So all in all, a lot of positive changes that I see. As again, I mentioned, this is just a draft, so none of this is actually in effect. There's one thing that I want to mention that actually might be a detriment, and that is a reduction or deletion of a lot of credits for electric vehicles. I know this is something that President Trump talked about a lot, and you would think that that's quite strange because him and Elon Musk were so buddy for a while there with Doge and everything Elon was doing. So he's doing Elon pretty dirty here, maybe with their reduction or elimination of an electric car credit. So if you're a Tesla owner, I hope that doesn't negatively impact you, or if you have solar panels on your house, again, the same there. But no, hopefully it's made up in one of these other reductions or possible deductions that we're talking about today. So that's it. I hope that was helpful. I know that a lot of this is just sort of wet concrete right now, and we're not sure what it's going to look like when it's dry. So if you have any questions, as I mentioned, please feel free to reach out to me. If you want to know how your tax plan works, or if you can better implement a tax plan that fits your retirement needs, please feel free to reach out to me as well. Always happy to take your questions and help as good as I can. So thank you all as usual for your viewership, and I'll see you next time.